Ladies and gentlemen, your attention please. Join me in welcoming our opening afternoon keynote speaker, Patrick Collison, the Chief Executive Officer of Stripe.
I need a dollar, 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 that's what I need. Hey, hey, well I need a dollar, 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 that's what I need. Hey, hey, said I need a dollar, 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 that's what I need. And if I share with
They have such flattering renditions of all the speakers to get us prepared here. So thank you all for coming. I thought I'd open with an old book that I was reading a couple evenings ago. And in fact, to show you this book, it'd be great to find a clicker. Someone got a clicker? Any of you guys take it? I want to go back one slide, actually.
That's my fault.
Thank you.
That's not your fault, that's my fault.
OK, and here's the old book. And there's this interesting quote in it, and I'm going to read it out to you. It says, "At present, computers are bought by individual companies or other institutions and are used only by the owning institution. If computers of the kind that I have advocated become the computers of the future, then computation may someday be organized as a public utility, just as the telephone system is a public utility. Each subscriber needs to pay only for the capacity that he actually uses. The system could develop commercially in fairly interesting ways. Certain subscribers might offer services to other subscribers. One example is weather prediction. A weather predicting company that is a subscriber to a central computer predicts the weather but keeps its predictions in its private files. If you subscribe to its service, your programs can gain access to those files. You may even have weather predicting programs run for your benefit to answer your own particular questions. Other possible services include those specifically connected with computing, such as programming services. Other subscribers might furnish economic predictions. The computing utility could become the basis for a new and important industry." This was John McCarthy describing Amazon Web Services and APIs in general in 1962, 50 years ago. And of course, he wasn't actually specifically describing AWS and APIs, of course, but he was describing the central ideas of the technologies that resulted with great prescience and lucidity. John McCarthy, incidentally, started the AI department at Stanford, which in turn resulted in the program that Marissa Mayer and Reid Hoffman from LinkedIn and Mike Krieger of Instagram all graduated from. And though people often talk about the challenges of timing in technology, I think the point is still underestimated. People think that it takes a very long time for good ideas to happen, and they're right. It takes a really long time, even longer than you'd think, and then usually twice as long again. And of course, getting timing wrong, being too early, is essentially the same as having the wrong product in the first place. This is true throughout technology. There were a lot of failed utility computing projects before AWS succeeded, and time-sharing computing, the technology that McCarthy was talking about, ended up being something of a dead end. In addition to being generally the case in technology, this timing point seems to me to apply particularly acutely to finance in 2013. Just as McCarthy could see that we needed to decouple the use of computing resources from the physical location of the machines, we can all see the central landscape reshaping transformation that's going to happen in our industry. Finance is becoming about software, and finance companies are going to have to be software companies. But of course, we don't know how and when and who and all the rest. We don't know if it'll take 5 or 15 or 50 years. These sorts of restructurings are inevitably painful, and finance, given its scale, certainly won't be an exception. I was speaking at a banking conference back a couple of months ago, and an executive asked me how I thought that bank branches could survive into the 21st century. But of course, this is the wrong question. It's like a travel company asking how to ensure that sort of high street travel agents survive into the 21st century. If you want to win, a lot of this stuff is going to go away. Now, in finance, not only do we have to contend with this timing problem, the additional challenge is that the scale is truly prohibitive. And I mean this seriously. The size of the market is certainly rewarding when you succeed, but its magnitude is probably a bad thing for new products and for new projects. All things equal, it's much easier to become and much more sort of sustainable to be on an ongoing basis a large company in a small market than a small company in a large market. To be successful in payments and in finance requires a kind of stamina that startups and disruptors are generally poorly suited to. And because it takes longer to win, existing companies and products have more time to react. It's extraordinarily difficult for new finance companies to successfully emerge in mature markets. And so here we are today. We know in directional terms what's going to happen, but we don't know when and how the shifts are going to take place. We know that it's going to be very hard to pull it off, and we know that most people will probably fail. I thought I'd open on an optimistic note. But it is a kind of optimistic note because for all the tribulations, things are going to get much better both for consumers and for businesses. And today, within the sort of finance to software transition, there are a lot of fascinating things happen. Just many of them are sort of taking place outside of the mainstream. M-Pesa in Kenya, which many of you are probably familiar with, they're doing a wonderful job of figuring out what it means to be a consumer bank in the 21st century. M-Shwari, which provides interest and loans on the M-Pesa platform, is less than a year old, but already has over 3 million bank accounts, which is more than 15% of Kenya's adult population. Zaad in Somaliland is a little bit less well known here, but is also performing very impressively. And for anyone who thinks that sort of their company has challenges, you should take a look at Zaad. Wikipedia describes Somaliland as an unrecognized, self-declared de facto sovereign state. They don't even have a government, so they're facing similar challenges to developing countries like the US. Sorry. So Zaad launched a couple of years ago, and already the average customer is using it 34 times a month. Coca-Cola is using it in Somaliland for 80% of their retail sales, and more than 10% of the adult population is on board. Consumer banking products that target American consumers are generally having a much tougher time. We all know that we will, in fact, be banking on our phones before too long, but figuring out how to sort of thread the needle, given the complexities and the size of the market, is very tricky. So I wanted to open with this framing, the finance to software transition and the timing issue and the scale point, because in addition to being the background theme for a huge amount of what we talk about at this event, it's also pretty central to how we think about Stripe and why it is that we pursue the strategy that we do. Stripe is a platform for internet commerce. We provide the infrastructure upon which other companies build online businesses. We handle everything from obtaining the payment credentials on a customer's device right through to depositing the funds in a business's bank account. We're just over 2 years old. We launched at the end of September in 2011, and we process billions of dollars a year on behalf of thousands of companies, especially the savviest, most forward-thinking ones. Much of the business we serve is in categories that didn't exist 5 years ago. This is not about sort of taking share from existing players. It's much more about expansion of the industry as a whole. We work with startups like Lyft and Foursquare, and also more established businesses like Rackspace and Walmart. And today, we serve merchants in 11 countries with the very same fully integrated stack. But still, I'm not going to give you the Stripe pitch. I'm not a very good salesperson. And anyway, I think it's sort of more interesting to talk through the ideas behind it. And in many ways, Stripe is not a new idea. Frictionless internet payments is a concept that's been around for quite a while. Ted Nelson described them when he invented the terms hyperlink and hypertext in 1974. This was a book that he self-published. But despite the idea of online payments having been around for a while, we decided to build Stripe for two fundamental reasons. The first is that we saw that there can and there will be more commerce happening on the internet, and we came to believe that this could be accelerated. We decided that it was possible, very hard, but possible, to, for example, double the amount of commerce happening online. And then the second reason is that we sort of decided that people are looking at online payments too narrowly, and the stack could be much deeper, that the payments layer could do much more. I think that the absolute size of the online market is generally sort of accepted too much as being outside of our collective remit. But its size, like the total amount of commerce that takes place, is not some non-deterministic outcome of the work of others. It's in our control and influenced in large part by the infrastructure built by companies like Stripe and others. We really have a role to play here. And by enabling more commerce, I mean both helping existing businesses operate more effectively and at greater scale, and increasing the number of businesses that exist in the first place. At a product level, enabling more commerce means thinking about the various categories of business and sort of trying to figure out what the limiting factors are on their number. It means thinking through the payment experience from the perspective of the customer and trying to eliminate concerns that they might have or interface friction and ensuring broad global coverage. And it means ameliorating the problematic edge cases of the payment, like declines and fraudulent transactions and so on. And if you think through the product like this and you sort of observe the deficiencies, I think you can fairly readily convince yourself that a huge amount of growth is possible. There's just so much low-hanging fruit that it's hard to know where to start. But you can approach it from a macroeconomic perspective too. It's hard to pin down exact figures since it's so tough to quantify the denominator, but a good approximation is probably that about 2% of global consumer spending happens on the internet today. The US is a bit ahead, of course. According to the Census Bureau, it's running at around 5%. But if you think about how much people in your cohort spend online or how much you yourself spend online, as you think about what that's going to look like in 5 or 10 years, whether or not e-commerce sort of entirely destroys or merely largely obsoletes traditional retail, there's a very long way left to go. And now, this doesn't have to be entirely hypothetical. Often you can see glints of these broader changes in sort of particular smaller markets. If you pick a country like the UK, for example, with decent payments and logistics infrastructure, you get a fairly different picture. They're running at around 10% today, and that's projected to grow to 16% by 2016. So who knows what the final number will be? Maybe it'll be 25%, maybe it'll be 35%, maybe 50%, but we're starting on a global basis at 2. So that gives you an idea of how much room is left ahead. And then the second idea upon which Stripe is based is that the stack should be much deeper. It's very easy for companies in a particular sector to sort of get satisfied and comfortable with their role. And once that happens, it's easy to miss additional value that you can be providing, especially when there's technological advancement involved that changes what's possible. Returning to earlier, I think AWS is a useful example here. For a long time, people looked at the hosting industry as about server rental. And then AWS and others showed that it means load balancing and distributed databases and queuing services and robust persistent data stores and so on. Realizing that they could do so much more has yielded a $4 billion a year business, if you believe analyst estimates, and I know that they're never wrong. But it's been a tremendous success, and we believe that this is possible in payments too. If you jump back a decade, the online payments market took on a sort of illusory, mature veneer in the early 2000s when people thought that it was only about credit card processing. Just as the computer industry itself, for example, was solidly established around undifferentiated beige boxes and Dell and a handful of other players. But then, as we all know, that stability proved short-lived. And we got smartphones and we got tablets, and all of a sudden everything changed. And as it happens, this shift that sort of upended the computer industry is also a large part of what's responsible for the changing stack dynamics in the payments industry too. We're all pretty familiar with the importance of mobile, and I don't want to belabor this point, but I would like to briefly highlight this chart from Asympco. It covers the dominance of various computing platforms over the last 40 years. It starts in the mid-'70s, ends in 2006. The beige-brown on the left is the TRS-80, the purple there is the Commodore 64, and the blue, of course, is Wintel. And there's really just nothing else. But then if we add the subsequent half-decade, if we go forward to 2011, we get something that looks more like this. And this is actually missing the last 2 years, and so you don't get the full picture of the collapse. Mobile is literally the biggest platform migration that's ever happened. And mobile had 3 major consequences for internet payments. The first is that the shift in the landscape changed what it meant to be a technology company and enabled the rise of a new cohort of businesses. Those companies rethought everything from hosting to payments infrastructure from scratch, and Stripe has sort of grown with them. Second, it changed what a payments platform had to be. The functionality required became more complex, and incumbent payment companies haven't reacted swiftly enough. And third, smartphones and tablets are finally bringing much of the rest of the world online in a significant way. And global presence is now much more important than it was 15 years ago. To me, the interesting thing here is that this shift both enables and necessitates a richer stack. Again, jumping back to our 10 years ago, online payments was about handling a US credit card at the end of your e-commerce shopping cart. It wasn't very complicated, and there wasn't all that much value to provide. Today, the most interesting and the fastest growing companies are typically doing stuff that's much more sophisticated and that requires much more from their payments layer. Mobile marketplaces are on the rise. Stripe helps them pay their sellers, not merely accept the payment, but pay their sellers and their service providers. Mobile also means that a company's user base is far more skewed towards non-US markets. So we help the companies that build on Stripe operate in multiple countries and process multiple currencies. The increasing complexity of these businesses in turn creates compliance requirements, and we help them navigate that. The richer ecosystem creates a bigger services market, and so we provide the infrastructure that helps companies manage subscriptions and recurring billing and so forth. We supply various libraries, and we help these companies build smart interfaces for mobile payments. We help them prevent increasingly subtle fraud. We build customer service tools. We assist with security. The list just goes on. And so in short, particularly as mobile devices proliferate, as online business models become more advanced, and as the geographic reach broadens, being a payments platform for internet commerce is becoming a more substantial and more valuable and, honestly, harder undertaking. And so this is the core of Stripe. There exists this market that's growing both in reach and in depth. And we've been very wary of these points that I mentioned earlier, those of timing and of scale. It's so easy to get lost in the ocean of one of these huge markets. And I think these are generally interesting questions to think through for all finance startups and even for new products at established businesses. In Stripe's case, we decided that the disruption wrought by mobile would create enough upheaval and whitewater in the market for a new entrant to be able to displace incumbents. And in terms of navigating the scale, we've tried to be very careful to focus on particular segments before sort of pursuing adjacent markets. A direct assault in payments on the whole space is a bit like a land war in Asia, and you really just don't want to go there. Instead, we focus first on software as a service startups, and then on marketplace startups, and then on startups generally. And now, increasingly, sort of 2 years in, large established companies are coming to Stripe. This strategy limited our scope in the short term, and in some ways it made it easier for sort of existing players to dismiss us as niche, but it also gave us sheltered time to iterate and to grow, which you really need if you're going to target a $1 trillion a year market. As we built Stripe, we've never believed in a sort of completely solo strategy. Not only would a unilateral approach make it harder to contend with the scale of the industry, but part of our belief is that the existing payment rails actually work very well in many ways. And so we're working closely with companies like Wells Fargo and American Express and Shopify and Facebook and a lot of folks that are sort of similarly interested in figuring out what the future of payments on the internet should look like. We've also attempted to keep a somewhat low profile. We don't do much press, and honestly, we don't even speak at many conferences. We wanted to get to table stakes without distraction from others. But we're now one of the bigger online payments companies and perhaps the main player among new technology companies. And so we think we now sort of have the platform in place to further these two goals that I spoke about. As we think through all of this, our primary aim remains very simple. We're looking to build the infrastructure that brings about these changes, the sort of ubiquitous economic layer for the internet that enables these new businesses and this new creation. Thank you very much.
Thank you, Patrick.